kind of going over, and this is, I know some of you have had auditing, some of you have not. So I'm just going to kind of go over a little bit of the basics of auditing and what we're going to kind of talk about. Okay. So here, this is basically, we're talking about financial statement audits. So financial statements. So the business creates their own financial statements. And these are the 4 financial statements that most of them will have. So income statement, sometimes called profit or loss statement. They'll have a statement of retained earnings, sometimes called change. Sometimes there'll be a changes in equity, which is a little bit more involved. Balance sheet, this is sometimes called a statement of position, and statement of cash flow. So these are the 4. Now, businesses make their own financial statements. So they, people, the auditors make the financial statements. No, they don't. The business, if it's a company, the company makes their financial statements. Now, as you might very well realize, if the company's making their own financial statements, people might look at these and say, well, can we trust these? They're making them themselves. So, they generally will lack credibility unless someone else takes a look at them. So that is the whole reason behind financial statement audits, is that there is this idea that the company that makes their financial statements, they lack credit. The financial statements basically lack credibility by themselves. It's somebody reporting on their own, business, their own actions, their own management, and all that kind of stuff. So this is where auditors come in. And that is, investors could be banks or whatever, require financial audits of the financial statements. So they need somebody to come in and take a look at the financial statements. That's where CPAs come in. So CPAs come in to take a look at those financial statements. Give me 1 second. I got to check something here. I don't think this is being recorded. It should be. Oh no, it says recording. It's got some stuff in different spots that I'm used to seeing. But anyway, we've been using Zoom for 3 years now, so I'm still a little rusty with it. All right, so the CPA firm will go and take a look at the business's financial statements, and their whole purpose of taking a look at it is to see if these financial statements can be relied upon. Now, here's where it gets a little bit confusing, and that the CPA firm will refer to these companies that they're doing the audits for. To them, they're clients, just like customers in a regular business. Okay, so let's take IBM. IBM needs an audit. They have their financial statements. Actually, they're required by law to have an audit. IBM is required by law to have an audit. A CPA firm will do their audit for them. Okay, now the CPA firm counts IBM as a client. It's one of their customers. IBM is going to pay the CPA firm to come in and take a look at their financial statements. Okay, this camera is flickering. I wonder if I can change that. Maybe I'm flickering. Maybe the camera is fine and I'm just flickering. Anyway, hopefully it's not flickering when I put on the documents. But anyway, so the CPA firm is going to do the audit for IBM. They will treat IBM as a client. IBM is paying their bills, so IBM pays the CPA firm to come in. Now, here's where it gets a little strange compared to other professionals. That unlike other professionals, the CPA firm must be independent from the clients. This is very different than, say, doctors or lawyers. I skipped over a part I shouldn't have. Well, let me head back up here. Certified public accountants, they're licensed by the state. So the state of Illinois will license CPAs, and it's just like a driver's license. You pass the CPA exam and you work for a year or two, and they'll give you the license. Kind of like when you get a driver's license, you take a written test and then they take you out on the road and see how you do. Same idea. And it's licensed by the state, so you can get licensed in Illinois and Indiana, and you get the idea. And nowadays they're transferable. You can transfer from one state to another. But the whole idea, though, is that they're independent. And they're independent because whoever's reading those financial statements has to be able to depend on that there's somebody not, working in the company that has taken a look at this thing. So they must be independent. So, for example, you can't buy stock in your client. If you're auditing IBM, you cannot buy stock in IBM. Then you would not be you would not be independent. You can't have, say, close relatives working in key financial positions at IBM. You can't, if my mother is the chief financial officer at IBM, I can't do the audit of IBM. That is a conflict of interest. It would be it would lack independence. And because of that, people would not, the credibility for the financial statements that we're supposed to be giving the financial statements would not be there. Okay, so this is kind of how it works. This is kind of the nuts and bolts of it. When we do a financial audit, we will end up giving them an audit report, and that report has an opinion. These are sometimes interchangeable. You'll hear people call audit report and audit opinion and back and forth. But the audit report goes along with the financial statements. So let me show you how that works up here. They will issue their income statement, statement of retained earnings, balance sheet, statement of cash flows. Along with that, there will be an independent auditor's report that will go along with those financial statements. The company still makes the financial statements. The auditors do not make the financial statements, but they'll give this independent auditor's report that basically says whether these financial statements can be relied upon or not. So this independent audit report goes along with the financial statements. Now, if the auditors do find something bad, they will tell the client, for instance, this IBM, hey, look, you have to change this or else you're going to get a bad report. So it isn't that, it isn't a all or nothing thing. It's sometimes kind of negotiated. Look, if you don't change these things, you get and that's kind of the whole purpose of having the auditors look at it. The company will actually put out financial statements that can be relied upon. So the independent auditor's report goes along with the financial statements. The auditors cannot themselves change the financial statements. And the reason for that is good because if they were able to change the financial statements, then they would be biased. They'd be their financial statements that they put out. So if the financial statements are always put out by the client, the auditors cannot change them. They may ask the client to change them, or else they'll give them, might impact the auditor's report, but they do not change the financial statements themselves. So this audit report goes along with the financial statements. And it gives the investors reasonable assurance. We never give absolute assurance, but we do give reasonable assurance about whether the financial statements are free of material misstatements. And we only look for, I should have free underline there too. We only look for material misstatements. Okay, so the audit report is not 100%. We don't say, 100% assurance that these are, we give reasonable assurance, whatever the level is, 99%, 95%, whatever it is. We give reasonable assurance about the financial statements, but only for material misstatements. So, for example, things that are material. Is a $5 million fraud material? Your gut reaction is probably yes. It's a lot of money. It depends on the company. A $5 million fraud to Walmart, not material, not even close. You know, when you have companies that have profits in the billions, no one's going to notice $5 million is off of a, be less than 1%, whatever it is, So it really depends on the company, what. Now, if you do come across a $5 million fraud, obviously you're going to tell Walmart about it, but you're not going to be looking for a $5 million fraud at Walmart. It's not material. So materiality really depends on the size of the company. And when you talk about it, we're talking about judgment calls. What is material? Is okay, $5 million to Walmart isn't, well, then what is? 50 million, 100 million? You start getting into, well, yeah, maybe, and again, it's judgment. Another thing about auditing is that it's all judgment. People think it's exact down to the penny. It's not. Not financial audits. Financial audits, you're only looking for material things, and it is reasonable assurance, not absolute. So it's a high degree of assurance, but it's not absolute. Okay, now, as the CPA firm, you need to gather evidence to support your opinion, and that's basically what this entire class is about, is finding evidence to support the opinion. We're going to give an opinion on this company, and we'll talk about opinions in a minute here, but we need to get evidence so that if we do get drug into court and they say, hey, these financial statements were misleading, we can say, oh, no, we did all our work, and we'll have that evidence that we can bring in with us. And they're called work papers, but basically that's what you do as auditors. You gather all this evidence up to form an opinion. So, the audit itself is really just gathering evidence. Okay. So let's do a couple of multiple, well, true, false questions here. Okay, certified public accountants performing financial audits are responsible for making their clients' financial statements. True or false?
False.
False. They are not responsible for making their financial statements. Certified public accountants are performing financial audits. Well, I read that wrong. Certified public accountants performing financial audits are responsible for helping their clients become more profitable.
True.
Actually, false.
False.
Yeah, that's and quite honestly, you want to avoid making, you cannot make any management decisions for them. If you think about it, that would make you not independent anymore, because your decisions would basically come out in those financial statements at some point, and you'd be auditing your own work. So you are not there to help your client. The best way to help your client is to stay independent. Okay, certified public accountants performing financial audits are responsible for providing their clients with accurate financial information.
False.
False.
That's false.
The clients provide the information. That you're taking their information and using it to come up with it. Now, who do you perform the audit for? Usually it's for outside investors or outsiders, people who don't know. Let me put that in somewhere.
Because there's internal auditors as well, right?
They are.
Okay.
I was one for, that's actually what I did in my auditing.
So how are you unbiased when you're an internal auditor?
You are biased.
Right, exactly.
Yeah, you can't do it. That's why internal auditors can't do the financial audit. They can do some financial auditing, but they can't actually do the financial audits as far as writing the reports for it.
Oh, gotcha.
Financial audits are for,
International auditor make only internal audit only on internal process. They don't do any, don't give any assurance. Only the CPA have to come and give insurance about the financial statement.
yeah, exactly. Yeah. So a CPA firm, it's an external firm. And by the way, when you pass the CPA exam, basically that's what it allows you to do, is to write that audit report. That audit report, you can only write that if you pass the CPA exam. And here's another odd thing about it. I know when you're going through college, they tell you not to plagiarize anything. No, you can't plagiarize, and all that stuff. If you're an auditor, you are required to use the language for the audit report. You can lose your license if you don't. So you must plagiarize in auditing when it comes to writing that report. It's very specific in what it says. It's very specific in the layout of it. So yeah, with that audit report, that, and it's, it's a couple pages usually, maybe 3 pages sometimes, but that's all that CPA exam is, so that you can write that report, and no one else can write it. It's a license. The same way, I can't practice medicine. I don't have a license to practice medicine. The same thing. Okay, so financial audits are for outside investors. They're not for people inside the company. They're not for management or anything like that. They're for people on the outside of the company who don't know whether the financial statements are reliable or not. Okay, certified public accountants performing financial audits are responsible for helping their clients make managerial decisions.
False.
False. Yep. And you don't want to do that because, well, first of all, you lose your license, but second of all, you'd be auditing your own work, basically. Certified public accountants performing financial audits may invest in their client's stock.
False.
False.
Certified public accountants perform financial audits, give credibility to their clients' financial statements.
True.
Yes, we got a good one. See, they're not all false, just 95% of them. All right. Certified public accountants performing financial audits will require their clients to make all necessary evidence available during the audit.
True.
True.
True. They have to give you all the information. If they don't, it's a problem.
They give you all adjustment, and you book them by yourself. That's correct.
What is
if
that?
Something wrong?
Oh yeah.
And then adjustment, they give it to the company, and the company posts them by themselves, not the auditor.
Yep. The certified public accountants performing financial audits are required to take all clients seeking financial audits. So are they required to take anyone who wants an audit? Are they required to take them?
True.
Actually, false.
No, because I believe you
That's
are
false.
selective about your clients, right?
You are selective about your clients. Yes.
They're required. Yeah.
And also, if you think about it, there will be clients that you're not independent. You can't take. If you have someone working at so you don't take everybody, and you are selective about it. And by the way, the CPA firm is very much into that client, the integrity of the client is the most important thing, according to the ACCT433. It's I in there somewhere. And you do not want to be associated with a client of ill repute for a couple of reasons, but the most importantly is this credibility that, by taking on a client that is, less than an upstanding citizen, you basically diminish the entire profession, but also anyone who has your name on their audit report, that you also harm them if you take somebody who is not who you shouldn't be. Okay, which of the following organizations can license certified public accountants?
AICPA.
Nope.
Hmm.
Now, the ACCT433 makes the CPA exam. They do make a CPA exam.
Isn't it the state board?
State board.
Yes, it's just like a driver's license. It actually even looks like a driver's license almost.
I think why this, I was thinking about the Security and Exchange Commission.
Oh,
Securities
I'm gonna
Securities and
stop.
Exchange Commission and the accounting oversight, these two kind of go together. And they don't actually make the license, but what they do is they register companies to make for the audits of what we call users. But you have to already have your license before you can do that. But they register CPA firms to audit publicly traded companies. And these publicly traded companies are known as issuers. That's the kind of lingo that we use in auditing. That when they are issuers underneath the Securities and Exchange Commission. If you're publicly traded, the Securities and Exchange Commission and Public Company Accounting Oversight Board, these two kind of go together. If you are a publicly traded company, these two, you have to follow their rules. And if you're a CPA firm, you have to register with them. But now your license is not with them, but the registration is that you can actually do audits of publicly traded companies. But now here's the funny thing about it. If you have a company that is not publicly traded, the Securities and Exchange Commission and the Public Company Accounting Oversight Board, which are kind of together, they have no control over you. So, IBM, they can tell IBM to jump through hoops, but, Joe's hot dog stand that doesn't have any external shareholders, they have no control over Joe's hot dog stand. So only publicly traded companies are covered by the Securities and Exchange Commission. If it's not publicly traded, they have no power over them. Only the states do. I think I might get to that later on. I can't remember if it's in here or not. It should be in here if it's not in here, but I'm going to bring a camera that doesn't flicker next time. Okay, let's see here. So Securities and Exchange Commission, it isn't that these don't have any power, they do. The registration of publicly traded companies is actually kind of big. And if you're a big CPA firm who makes their money auditing publicly traded companies, if they were to pull that registration, it would end your CPA firm. But the State Board of Accounts, they're the only ones that can issue a license, they're the only ones that can revoke it. So they'll issue your license and they're the only ones that can revoke it. Hopefully they don't need to do that, but if they do, kind of like driver's license. The state issues it, state can take it back. Okay, oh, here I have the issuers, non-issuer thing. Okay. So I think there was only 2 pages. No, there's 4 pages of this. Never mind. Okay, types of clients. Non-issuers are privately held, and the only people they have to answer to, they have state laws and the AICPA rules. Whoever does the audit, they're generally held to the AICPA rules. A lot of times the AICPA rules are laws. They become laws. And I haven't really talked about what the AICPA is. American Institute of Certified Public Accountants. It's a club. That's all it is. The AICPA is a club. When you pass the CPA exam, they'll send you a thing in the mail that says, hey, do you want to join our club? And you can say yes or no. You don't have to join the AICPA. AICPA, though, is the most influential of all the groups in the United States. Again, they're just a club. They are not a government agency. They don't have any direct power at all. Now, how do they get their power? They get their power because their rules oftentimes become state laws. So when they come out with a rule, the state says, hey, that's a good idea, we'll make that into a law. So sometimes their rules actually become real laws in the states that are running them. They also make the CPA exam. every single state uses a CPA exam, maybe the AICPA. They don't have to. They could wake up and, Illinois could say tomorrow, we're gonna make our own CPA exam and license people that way. No state actually has, and I doubt they ever will. But the ACCPA makes the CPA exam, and they grade the CPA exam. If you have a problem with the grading on the CPA exam, you don't contact the state. The state has nothing to do with it. Contact the AICPA. The AICPA makes the rules for auditing, like we're doing. They also make the rules for accounting. Again, this is just a club, though. It's a club, so you say, okay, they have no real power of their own, other than government agencies that tell people what to do based on the ACCPA. And that's one of the things about the accounting rules. So we have auditing rules, and then we have the accounting rules. And the accounting rules, the Securities and Exchange Commission says to all these companies, by the way, there's this group over here, it's a club, it's like, the Boy Scouts, but they make their generally accepted accounting principles you have to follow. So even though the AICPA does not have any power over any company, the SEC does, and the SEC says you have to use their rules. So it's kind of an indirect power that they have, but they have actually no actual power of their own. It works out well that way. That we have this kind of separation. Okay, so non-issuers, if it's privately held, they only have to follow state laws, and their auditors will also have to follow the AICPA rules. Generally, that's is a requirement. If they're issuer, publicly traded, they still have to follow the state laws. They still have these state laws they have to follow. They still have the AICPA rules they have to follow. But they also have two more, and that is the PCAOB and the SEC. And PCAOB is part of the SEC. They kind of split up the stuff a little bit. Basically, the PCAOB is more like the auditing, the reporting part of it, and the SEC is more of the accounting, but it kind of gets blurred a little bit. The PCAOB came out of Sarbanes-Oxley. Gave us a PCAOB. You wish I could have came up with a better grouping of numbers, because that does not roll off the tongue, but anyway. All right. Types of financial audits, audit reports, audit opinion. Okay. So audit reports, yeah, I think I told you about this already. Audit reports and audit opinions are often used interchangeably. Okay, so the report that everybody wants to get is called the unmodified report if it's non-issuer, and it's called an unqualified report if it's a PCAOB. And unqualified just means, a qualification would be everything's okay except for this bad thing. That's a qualification. So they're saying there's no qualifications, that it's good the way it is. And this is for reasonable assurance that financial statements, reasonable assurance that the financial statements are free of material misstatements. Now, it's not saying that they are free of all misstatements. Immaterial misstatements are okay. So be careful on this. If you're given a question that talks about something that's immaterial, you know, this thing it was an immaterial misstatement. As external auditor, we pretty much ignore it. When I was doing, I was an internal auditor and I was working with external auditors, which is very common. If you're an internal auditor working inside a company, I worked for Navistar and for US Steel. And Deloitte & Touche was the auditor for both of those, by the way. So I worked with the Deloitte & Touche people quite a bit. But I remember one time coming across a $100,000, this was an insurance company that Navistar had. They came across this $100,000 error. It was $100,000 that they had listed as investments. It was actually in cash. And I remember bringing it to the audit senior, and he kind of looked at it like, "Why are you showing me this?" You know, to me, like $100,000 error, that's huge, you know. But he was like, "It doesn't make any difference. It could be hundreds of millions of dollars in the thing." But anyway, that was an immaterial, and they don't care. and by the way, if you are working with the external auditors, or if you go into public accounting, do not write that up until you talk with the senior, because if you write it up, generally anything that you write up in the work papers, they have to clear. And so before you write that up, ask your senior if it's material or not, or if you should do it, or how you should do it. But immaterial misstatements are fine. Not that you encourage them, but we don't worry about them. Okay, modified opinions. Modified opinions. These are the bad ones. So modified qualified report. And for the PCAOB, they generally just call it the qualified report. So modified, AICPA calls them modified, qualified, and PCAOB so this is for non-issuers. And this one is for issuers. So publicly traded versus non-publicly traded. I'm adding that to the dictionary. I don't know if non-issuers really is. I think it is a real word. But these are sometimes called an except for report or except for opinion. And the reason why they call it that is they're qualified. They say, okay, everything is fine except for, and then they'll tell you this bad thing. So it's called an except for opinion. It'll say overall the financial statements are fairly presented. And they'll say except for, and then it says, you know, whatever they can come out with. And except for are usually for material misstatements that are what they call not pervasive, and that overall the financial statements can be relied upon. Let me write that in. Generally, they're limited to one account, maybe two accounts. Okay, so this is for material misstatements. They're not pervasive. And that's AICPA wording. They're not pervasive, usually limited to so material misstatements that are not pervasive, and they are usually limited to one or two accounts. So for instance, maybe the advertising expense is off. Okay, so the advertising expenses is maybe off, but you know, maybe it's misclassified as something else. It might be material, but again, it's limited to that one thing. Everything on the balance sheet, the cash on the balance sheet, the inventory and all that kind of stuff is fine. But you know, one of the accounts is not, for whatever reason. So a modified qualified report or a qualified report is an except for, they say everything is okay except for this, that overall the financial statements are fairly presented. So that is a modification according to the ACCT433 or just a qualified report. And it's qualified and it says everything's okay except for, and then they give the qualification, except for this one account is bad, whatever. Okay, C. These are the worst ones you can get. A modified adverse report or adverse opinion. Adverse report. And this is when the financial statements, there are material misstatements that are pervasive. How should I say that? So put it like this. So material. Throughout the financial statements. The financial statements are misleading. And not fairly presented. And even further, they're not GAAP. Not generally accepted accounting principles. So not GAAP. Let me clean that up a little bit. So this is the worst one you can get. Now, these two, the modified qualified report and the modified adverse report, these two are fairly rare. And they're rare for a good reason. And that is that the dollar amount that they are misstated by will be shown in the report itself. So, dollar amount. Let me clean this up. Let's try that again. There we go. So if it's misstated, now remember, the auditors cannot change the audit report, or they can't change the audit report. They cannot change the financial statements. The auditors can't change these financial statements. So this audit report is the only thing they have. They will actually put the dollar amounts for a qualified or an adverse opinion will be put right in the audit report. So it isn't like no one's going to know. For that reason, it doesn't do a company any good to get a qualified report or especially an adverse opinion, an adverse report. It doesn't do them any good because it's going to be in there anyways. And not only that, it's going to make them look double bad because it's going to show that their financial statements are basically fraudulent. So it doesn't do a company any good to get adverse opinions. Now, do they happen? Yeah. You get people pounding on tables. You can't put that as in revenue. Pounding, yes, I can. I will put it in as revenue. Does it happen? Yeah, but it doesn't. Logically, it should never happen because again, it doesn't do a company any good to do that. It shows up in the audit report and people reading it will not only know the company's doing worse, but also it makes it look like the management cannot be trusted, even, even worse than, gee, the company's not doing as well as we thought it would. So modified and qualified and adverse opinions, the dollar amount is in the audit report. These are rare. They should actually never happen, but they're very rare because they don't do a company any good. The dollar amounts are shown in the audit reports. Okay, now there is a fourth one here. What time is it? I spent too much time on this. Well, we're almost done with it. All right, well, we'll finish this up and then we'll take a break. Modified disclaimer of an opinion, or a disclaimer of an opinion, often called just a disclaimer. A disclaimer happens when the auditors are unable to get enough evidence to support an opinion. The amount of misstatement, if any, is unknown. So a disclaimer is given when you don't know how much it's off by. It might not be off by anything. It's unknown. And so, for a disclaimer, you can't really put in the dollar amount. You don't know. The financial statements might be fine. They might not be. You have no idea. You don't have enough information to make an opinion. So that's what a disclaimer of an opinion is. Now, a disclaimer of an opinion is like nothing. So, it's no opinion at all. The two best opinions are the clean opinion or the unqualified or unmodified. Those are the best. The qualified is probably the second best. The adverse is the worst, and the modified is no opinion at all. And so notice that you pay for this audit, here's our bill, thousands of dollars or millions or whatever it is, and here's nothing. Because a disclaimer is nothing. It's literally nothing. It's when you shrug your shoulder and say, look, we can't get enough evidence. So those are the audit opinions that we have to put, that we can put in for the audit. And again, the modified, qualified, and the modified adverse are rare because we put the dollar amounts in. Disclaimer of opinion, those are rare also. Usually that's some kind of a, it really depends. But let's go through some of these. How many are there? 4, 5? We'll go through these 5 and then we'll take a break. Okay. The auditors determined that cash, inventory, and revenues were all materially misstated. Which audit report would be the most appropriate for this scenario?
I think so. Modify qualified report.
Probably modify the adverse.
Adverse.
It looks like the revenue, so the income statement's going to be off, the cash and the inventory, so the balance sheet will be off. This would probably be enough that you'd probably have it. It is possible that you'd have a qualified statement, but more than likely this one would be modified adverse. Okay, the auditors determined that cash, inventory, and revenues were all immaterially misstated. Which one? Yep, good.
5.
Yep, unmodified, you know, if they're off by some small amount, it's not gonna make a difference to the investors, that's fine. So immaterial is, we don't encourage it, obviously, but, we don't modify the report for it.
Disclaimer.
Which one?
Disclaimer.
Yep, disclaimer, this one, let's see here. Yeah, very material, verify a material amount of offsite inventory in his books. It's possible on this one, let me look and see if this, it is possible on this one to get a qualified, and I'll explain why. If it is not pervasive. So for instance, if it's just limited to this inventory account. For instance, maybe none of this inventory was sold, so it doesn't affect the income statement, but it's just this one account. It's possible for one like this that you could also give a modified qualified report. And tell, you know, you would tell them basically that this offsite inventory could not be verified. So even if it was materially misstated, that it would be not pervasive. You know, all the other accounts you can look at are fine, the cash and accounts receivable and all that kind of stuff. But that this one account was off. So this is one that you could actually have two different choices. And basically it's a judgment call. You know, and it probably depends on how material the material amount is, but yeah, so this one would be one that you would it's possible you could have more than one report for this one. And notice that this is just one account, whereas this other one was multiple accounts up here. And you know, this is unable to verify. Okay. Oops. Oh, now I goofed everything up. All right. Let's go to 13. The client refused to allow the auditors to talk to the client's lawyer. Okay, so you tell the client, we have to talk to your lawyer. You know, there's a thing called a lawyer letter we need to get. But the client says, you're not talking to my lawyer. Now, notice when the client refuses to let you do something, it makes you more suspicious, right? So for instance, if you're doing a murder investigation, you come to my house and I say, yeah, you can look all around, but just don't look in this closet, you know? Well, that's the first place you want to look, is in the closet, because, you know, and the same thing with this. When someone tells you they can't talk to a lawyer, the immediate question is, well, why? So the auditor will not, or the client will refuse to not let you contact their lawyer. Now, you don't know why at this point. You know, it could just be the client's acting strange, but you don't know exactly why.
Modified.
It'll be a modified, which one?
Unmodified or unqualified, the A. Because we don't know any reason for why.
Well, yeah, this one is when you get enough information to make a decision. This one you don't know. This is unknown. So which report is for unknown stuff? Wait, where's my question? Oh, I just goofed that up again. Isn't this fun watching me learn how to use a computer? You know, there might be a huge lawsuit sitting out there. They might be being bought out by another company. You know, they may have someone. Go ahead.
Disclaimer, opinion.
Yes, disclaimer. And this is true, we'll find, this is what they call a client imposed scope limitation. Whenever let me write this in before I can talk about it. Okay, this is what they call a client imposed scope limitation. When the client does not give you the information, now they're supposed to give you everything you need for your audit. You know, that's the whole part of it, you know, you might need to get their tax returns, you might need to get their, you know, certainly their bank statements and all this stuff. And when the client refuses to let you have that information, that's a client imposed scope limitation. Those virtually always get disclaimers. Because there is that, well, there's a reason why they're not letting me have this information. Whether it's a lawsuit or, you know, whatever it is. It's possible that you might do a modified qualified report, but usually, you know, basically you have to have a good reason not to do a disclaimer in this case. So when a client imposes a scope limitation, the client will not give you the information you need. They generally get a disclaimer. You know, here's nothing, basically. And again, these shouldn't happen, but do they? Yeah. We need to talk to your lawyer. They're pounding on tables. You're not talking to my lawyer. Okay. Why are scope limitation, or excuse me, why are qualified and adverse opinions rare? Yep. Yeah, they're rare because the qualified and adverse opinions include the misstatements. You know, it isn't like no one's going to know that they have overstated their income or whatever. So they will. It'll be right there in the audit report. Okay, so you can submit that one in Blackboard. Now let's go ahead and take a break. What time is it? 7:08. I went too long here. Let's see. I tell you, when we come back, we'll go into we'll start chapter 10. Let me pull that one up and we'll take a break. We won't get to the sampling one today. So let's say be back at 7:19. How about?
I have a question, please.
Okay, let's go ahead and let's see, started on the chapter 10 handout. So the chapter 10 handout is on cash and it's about gathering evidence. You know, one of the major accounts that we look at a cash, and we'll kind of talk about why, but this is that gathering evidence. You got to get enough evidence so you can make a form an opinion on the financial statements. Okay, so we basically in accounting only have really 5 types of accounts, depending on how you classify them, but basically there's revenues, expenses, assets, liabilities, and equity. So these are the 5 types of accounts. It's actually kind of ingenious when you think about it, that every transaction you can think of, no matter how crazy it gets, can go into these 5 categories. Which one of those 5 would be the easiest to prove, do you think?
I think the revenue and the expense.
It's possible that these would be, you could prove them, but the one that's probably going to be the easiest to prove is going to be the assets.
Assets.
Now,
Access.
what we'll find out though is that these are all connected. Obviously, revenues. You know, if someone gives you cash to buy something, that's an asset. If you spend cash to pay an expense, you know. So, but assets are probably the easiest to prove, and that's why we'll often start out with cash as, you know, it's the asset. Assets are easiest. They're easiest because, you know, you can get, for instance, cash. You can get bank statements. You can look at land, building. You know, we're sitting in a building right here. Well, here we are. You guys are sitting in your houses, but some of you, anyways. But they, you know, assets are basically easy. You can actually see them. If you look at a company, you look at Walmart. What are you really looking at? You're looking at their buildings. That's an asset. Their parking lot. That's an asset. Their shelving, which is equipment, basically that's an asset. Their inventory is an asset. You look at all their assets. So assets are the easiest to prove. Next easiest would probably be the liabilities, because these are paid. So whenever you see something being paid, you probably can make the inference that that was a liability. So when we do an audit, we'll beat up the assets, we'll beat up the liabilities, and notice that if the assets and liabilities are okay, that tells us that the equity is okay. Right? And if the equity is okay, then the income statement must be okay, because the income statement flows into the equity section. So basically, when we do an audit, we can get a very good assurance by just looking at these 2 types of accounts, assets and liabilities. And they're pretty much attached to all these other ones, and we'll talk about that in a second here. Okay, audit of cash. Okay, so, you know, what do we know about the audit of cash? What do we do with it? Audit of cash. First of all, the audit of cash, oops. Well, the dollar amount in the cash account may be immaterial. Cash account is directly linked to almost all other accounts. Okay, yeah, I like that. And we'll talk more about this in a minute. So you, okay, well, so what are we gonna do with cash? Well, cash, well, the dollar amount might be immaterial. You look at cash and go, okay, well, there's a bunch of other accounts that are bigger than cash. However, almost every account goes through the cash account. It's almost hard to figure out an account that doesn't. You know, if you make a sale for cash, you know, it goes through the cash account, but if you make a sale on account, okay, eventually that account gets paid off, it gets paid off with cash. You buy some equipment and you give a loan, you get a loan for a car or a truck or whatever. Okay, when you pay off that loan, what are you paying it with? You're paying it with cash. So it's almost difficult. You know, the only thing I can think of is something like if someone traded land for like stock or something, you know, I guess that would be, you wouldn't deal with the cash out, but it's almost difficult to come up with ideas for accounts that don't go through cash or transactions that don't. Okay, oops, two. The cash account will often be audited to 100%. In other words, you can look at every single thing in it. This is not usually the case with other things, but you can the cash account, you can get bank statements. You know, you can get bank statements, you can get you know, look at the cash account, they'll look at the petty cash and everything else, but you can get 100% of it, which there's a lot of accounts you can't. For instance, if you were going to do if you're going to try to do a year-end inventory for Walmart, it would be absolutely impossible. There's not enough auditors in the world to do that. There's probably not enough employees in Walmart, certainly, to do a complete audit of every single item that Walmart has on December 31st. You're going to have to take a sample of it because it's going to be impossible. Cash, you can do that. You know, yeah, they may have, you know, 3,000 cash accounts across the country. You can find the financial statements for 3,000 cash accounts. That's, you know, that's not impossible. 3,000 is not an unattainable number for auditing. So one thing we can audit cash 100%. So that is also one of the things that make it important, is that we can actually get very comfortable with the cash balance in it. Third one, and this is kind of from the fraud point of view. For fraud, cash is the most desirable asset. Everybody can use it. So, you know, if you steal merchandise at some point, you know, yeah, you may use some of it for yourself, but at some point, if you have to sell it, you know, how many lamps can you have in your house before you, okay, well, if I'm stealing lamps, I got to figure out some way to sell it and turn it into cash, whereas cash is already there. So it is actually one of the more vulnerable assets in that it is, everybody can use it. Okay, so this idea, though, that cash is directly related to all the other accounts, you know, if we come down here and we look at this cash account, almost all these other accounts will be related to it. So for instance, we might have cash sales that go directly into cash. So while you're proving this cash account that you can do a lot of times at 100%, you can also be proving the revenues. Now, we might have, you say, what about, you know, stuff that's sold on account? Okay, that goes into accounts receivable, and then that goes into, when those get paid off, those go into cash. Yeah, and same thing with, yeah.
Cash. Expense go to cash and inventory.
One more time.
Expense go to cash and inventory.
Yeah, so this is gonna go, so this will be, and so, for, yeah, let's do the inventory. So inventory, okay, well, inventory, let's say we buy inventory on account, right? So we buy the inventory, we get the inventory, it goes into accounts payable, we owe somebody for it. Well, what do we pay them with? We pay them with cash. So the idea here is that virtually everything you can think of eventually is going to run through that cash account. So when we do 100% audit of the cash account, we can also take in all these other accounts too. If we pay for expenses, cash. Okay, well, let's say we don't pay for them right away. Let's say that we wait, we get a bill, we don't pay it right away, it goes into accounts payable, and the accounts payable comes back to cash. It's kind of like all roads lead to Rome, all roads lead to cash. So if you look at the cash account, you can actually get a very good understanding of the revenues, expenses, most of the other accounts that are on those financial statements. So it's a very important account to look at, and that's why there's a lot in it. This is probably the most, it has the most audit items in it as far as finding evidence of any of the other accounts. And again, a lot of times it's immaterial. You look at the dollar amount, it's way less than the inventory, and so if you just look at the dollar amounts, it's not a very important account to look at. But because everything runs through it, cash becomes a very important account. Sort of like blood. Okay, segregation of duties. One of the things that's important we'll talk about, and that is the controls over it. So these are the internal controls. Actually, you aren't over anything, but we'll say for cash in this instance. Okay, segregation of duties. We remember it by car. First one is the custody of the asset. Oops. Next one is authorization. And the last one is record keeping. I think it's one word. Record keeping. So custody of assets. All right, so custody of assets, this is whoever owns the assets. For instance, cash would probably be the Treasury Department. Authorizations, these would usually come through usually the accounts payable, but it could be other organizations too, other parts of it. Let's just say accounts payable. And the record keeping is done by accounting. So if something's going to get paid, usually accounts payable will be the ones that pay it. They will issue the approval. So the Treasury Department, who has custody of the assets, will cut the checks. And the accounting people will keep track of that. We will do the you know, the record keeping, but also we'll do the, like the bank reconciliation. So segregating out these duties. Now, you do not want these duties to be overlapped. For instance, if someone from the Treasury Department could do some of the record keeping. Notice they have custody of the assets. They could make the asset disappear and they could use accounting to cover for it. You know, if someone from the Treasury Department were to run off with a bunch of cash, the accounting department would find it because they do the bank reconciliation. They say, hey, how come that cash is all gone? And that would immediately trigger, you know, who took it. But if record keeping and accounting were working together, or they were, you know, those duties were overlapped, they could make it disappear, and it'd make it disappear in accounting, and it'd be very difficult to find. So segregation of duties is one of those things we have to segregate out who can do what. And remember it by car. Almost always when you find something, a problem, it's some violation of that. Okay, so let's see what we have. So this is going to be kind of receipt of cash, kind of the flow of it. All right, so Joe customer sends a check to ABC Corporation. Okay, so it will go to either the mail room or accounting room for the company. I used to work in one of those, by the way. When I was going through college, I worked as a maintenance guy for a bank, and I had to go. When they were counting the checks, I had to go. Is this thing not letting me do it? Okay, so the check will go to the mail room or the accounting room. Oftentimes, there's two people working there. And they will make a checklist, list out all the checks. By the way, why would you have two people doing that job? Why would you have two people in the mailroom?
Accountability.
Yeah, it makes it less likely that anything is going to happen. And there is a kind of a logic to it that if you, yeah, okay. So that let's say that the average person, that 10% of these people would be likely to steal, which I think is very high, but okay, so if you have one person doing it, you know, the risk is 10%. If you have two people doing it, notice that they would both have to be wanting to steal the money, and your risk goes down to say 1% just by adding one person to it. So and it's probably even less than that, because you know, even if both of these people wanted to steal, they may not feel socially that they're going to contact this other person and say, hey, I want to steal money. So it could even be much lower than that, because you know, but this is the idea behind it. The more people have it. Now, people in management will look at this and go, well, why do you have two people doing the job that one person can fill out the list, right? I mean, who cares, you know? Why do we have two people doing it? Well, this is why we have two people doing it, and because cash is something that everybody would want to, you know, anyone would want to take it if they were looking to do so. Okay, so, and by the way, you know, I was a maintenance guy, and there was another guy that did mailroom stuff, and we would both do the checks, and we'd both count the checks and do the checklist together. I know that I didn't really know exactly why we were doing it, but you know, it was like, here's your job, and I didn't ask any questions. Okay, so they're gonna make two checklists. They're identical, but they're gonna make two copies of it, I should say. And the one checklist, they're going to send to accounts receivable. And why are we gonna send it to accounts receivable? So we got this
Record.
check.
To record.
Exactly. Yeah, this is gonna be the bookkeeping part of it. They're gonna record it, you know, if who's this customer? Joe Customer. Hate to say it, but the auditor, he says that's probably a fake name. But anyway, Joe Customer, you know, sends this check in, you're gonna send, and so when they get this list, you can send to accounts receivable, and say, oh, looking at the list, okay, Joe Customer sent 300, no, this is the one Joe Customer sent. 1, 2, 3, 4, 5, and so they'll put in the accounts receivable, okay, Joe Customer sent 1, 2, 3, 4, 5, okay. Now, they're gonna send the checklist too, so accounts receivable has the bookkeeping here. They're going to send the checklist to the cashier, whoever handles the cash. And we're also going to send them the actual checks. And they are going to put those checks on the deposit slip. And this other cash, this is cash they might collect from other, you know, from the cash registers or something else. And then this is the amount that they're going to put on that deposit, and make that green say. And so the bank statement, when you get the bank statement, it'll show that deposit. Okay, so first checklist goes to accounts receivable. They just get the list. The cashier will actually have the custody of the asset. They'll make the deposit into the bank. That's, you know, that's still custody of the asset. And that will be shown as a deposit of 1,038.01. Ooh, me, I'm boring myself. Okay. Okay, down here, notice, you know, let me zoom in. Notice that individual checks cannot be verified with the bank statement. Okay, if you look at the bank statement, this is the amount you're going to see. If you're looking for Joe's check of 1, 2, 3, 4, 5, you're not going to find it on this bank statement. You're going to find the total deposit of 1,038. So you cannot look at the bank statement and figure out if somebody mailed in a check. What would you have to look at?
The slip or checklist.
Checklist and deposit slip. Yep. These two, this is what you'd have to look at. You know, you could look to see if someone's sending the check on the checklist and also deposit list. It should be on both these checklists, obviously. But the deposit slip is what you're really going to look at and see if it went in, and you know, on the checklist, because it could be the cashier stealing the checks, so you want to look and see that they're on both. But yeah, the bank statement isn't going to be much help though, because it's just going to show the total amount, and you'll have no idea. You know, the 1, 2, 3, 4, 5 could be in any one of these or none of them. Oh. I'm going on a long way to talk. It's right here. Individual checks must be traced to the checklist and deposit slips. There we go. See, Wasn't lying to you, I was just wasting your time. Okay. Let's go to the first one here. If an auditor needed to confirm that a customer had submitted a check to the client, which documents would the auditor likely examine?
Bank statement.
A checklist.
Checklist. Yep. Yeah, and overall, you look at the bank statement, but if you want to see an individual check, you're going to have to go to the deposit slip or the checklist. And in this case, these two would probably be the ones you'd want to look at. And notice that, if a cashier took the check, well, what would that look like? It would be on the checklist, but it wouldn't be on the deposit. If you go to the bank without the 125, it wouldn't show up in the deposit for the bank. So if the cashier took it, it would be on the checklist. It would probably not be in the deposit because that would be caught immediately. Okay. If a customer cashed a check, if a customer's cash check was missing and it did not appear on the checklist, who likely misappropriated, stole the check? So it did not show up on the checklist.
Accounting room.
The account, yeah.
Yep, exactly. People in the accounting room probably took it. It was probably taken, if it didn't show up on the list, it disappeared before it. So yep. I think we'll do the lockbox and the bonding and lockbox, and we'll call it. And number 3, we'll do, and then we'll call it a day. Okay, bonding of employees. Employees that handle cash will often be bonded or have a financial bond. Bonding is an insurance policy in the case of employee theft. Bonding is an insurance policy in case employees steal cash. So you bond employees. So if you work as a cashier in a bank or something like that, a lot of times they'll be bonded. People who work with cash will be bonded. And the bonding company is just an insurance company, and they say, okay, if anything bad happens, we will reimburse you for however much was taken by the employee. Now, the insurance company, the bonding company, they're not stupid. And so the big thing that they do is background checks. So while it's just plain old insurance, there's nothing magical about it. It doesn't make your business any more secure. It's just insurance. The part that really helps out, though, is they do background checks. And they'll do background checks on any new employee, and if they don't find anything, they'll usually will bond them. If they do find something, they won't. And by the way they usually this comes about, I actually had a friend who worked at a place there that this guy went through the interviews and everything was fine. They went to have him bonded, and the bonding agency just said, "Wait, we're not going to bond him. You can hire him, but we're not going to bond him." And he had been convicted of fraud a few times. Obviously that didn't come out in the job interview, but yeah. So bonding with the big thing they do is they do background checks. And the background checks will usually highlight. One of the strange things about fraud is that people who commit fraud oftentimes will commit it their whole lives. You know, even if they go to jail, they come out, they do it again. They, you know, the recidivism for fraud is incredibly high. So that's one of the reasons why if they've ever done any fraud, they usually are not bondable. And that's one of the key things about why the companies will do it, is that they will avoid having somebody like that get in there. Okay, a lockbox system. A lockbox system is there to avoid this. You know, this whole thing up here is to avoid this. The lockbox system, and this is the way a lot of places work now. Customer payments are sent directly to the bank. The bank will deposit the money directly into the bank account. The checklist will be sent to the client. Okay, so a lockbox system. First of all, why it's called a lockbox system. Banks back in the day, actually, when I was a kid, we used to have these. Banks would have this big, heavy thing sitting out front, and it would be locked. Customers would put their payments in, and close it up, and then the payment would drop down inside, and it was a lockbox system. Customers paid directly into the bank in these lockbox systems. Well, it's sort of the same way, except that it comes through basically their accounting rooms or whatever they have set up, and they will directly, so the bank will make the checklist, deposit those directly into the account. The employees of the business never actually have the opportunity to even take a check, because they don't come to them. They go to the bank directly. So usually it's faster. Now the bank charges for the service, obviously, but it's faster. It goes directly into the bank account. They get a checklist from the bank, and let me make this a little better. A checklist will be sent to the client from the bank. Yeah, so that is kind of what a lockbox system does. Okay, and number 3, which of the following are true regarding a lockbox system for cash receipts?
D.
E, the client can probably never have access to the customer check.
Yep. And again, you don't have to worry about this segregation of duties and the checklist and looking for all this stuff. Yeah, that the employees will not have access to it. Okay, I'm going to stop right here. We are not going to turn anything in this week. I'm going to make sure that we get I got to get the textbook up. This will be job 1. I'll do that tomorrow. And we probably will finish this next. Look at that here. We might spend a little more time on this one. This is definitely the biggest of all of them. I know we start out with it, and maybe that's unfortunate, but this is the biggest of all of the chapters. I don't mind spending extra time on cash because of this. It covers everything. So I don't mind spending extra time on cash because it actually is looking at everything else in there too. Okay, so we'll have nothing to turn in this week, and next week we'll start up, where we're, and next week we should have, and again, don't worry about the handout that I know we have it like every week. They show something on there. Don't take that as, proof or,